So you have 25% of the US GDP that really hasn't adopted a technology at the same pace as Fortune 5,000, Fortune 500 that you're seeing out there.
Hello, everyone. Welcome back to the Carta Data Minute podcast. I'm your host, Peter Walker, head of insights here at Carta. Today, I was joined by Liza Benson, principal at Moderne Ventures. Now, Moderne is a pretty unique venture fund. They interact almost exclusively with companies that are touching real-world industries like real estate. That's pretty far afield from the normal software GPs that we talk to on this show. And Liza is a wealth of information about how those companies are doing, how to interact with regulated industries, and why more founders should be talking to the real estate industry specifically. We got into their successful fundraise for their most recent fund, no easy thing in this environment. We got to talk a little bit about their Passport program, which allows companies that are way above the accelerator level to still engage with a ton of curriculum and learn how to engage with commercial contracts on the real estate side much faster than the normal early stage startup. We talked a little bit about what LPs are looking for in this new class of emerging managers. Of course, we discussed the ins and outs of day-to-day at the fund, how they split their time as investors in multiple different verticals, et cetera, et cetera. But we closed with an idea around why so many fund managers these days are finding it difficult to raise above and beyond the macro conditions. And so if you're a fund manager, I think Liza's got a wealth of information for you on what really matters to LPs. Let's jump into the conversation right now. Liza, thank you so much for hopping on the podcast, our first virtual podcast. Congratulations. Thanks for being the first.
Thanks, Peter. Live from Vegas right now.
How is Vegas? What are you there for?
There's a bunch of conferences, actually. There's a HumanX, there's RetCon, there's a FinTech conference. So kind of covering them all this week.
I love it. Kill three birds with one stone in that way. But well, appreciate that you are happy to jump on this this podcast with us. I wondered if we might kick things off with you giving a little bit of background on Moderne and the kinds of companies that you love to invest into.
Absolutely. So Moderne Ventures is a venture capital fund that invests in technologies around real estate, FinTech, InsurTech, and other ancillary areas. Fundamentally, we're different than your typical venture capital fund because about half of our LPs are strategic to the industries that we serve. Those LPs are not investing in us just for venture returns, but actually in terms of the innovation that we bring to their businesses. We're very systematic on how we do that. It's not just email intros. We have an entire platform team that we call Passport. That works with all of our companies over a 6-month period to really actually build their sales pipeline. It's really not about, early stage man with a plan sort of product market fit. It's really about how do we accelerate your company into the industries that Moderne serves. We actually take about 20 companies a year into that program. We invest in about 5 to 7 initially, some we invest in later. And really the purpose of having that program is multifaceted. On one side, our strategic LPs are getting to see the new, exciting, innovative things that are happening. And on the other side, the companies are building pipeline. And what's the most important thing in terms of, building a company is building their revenue streams. Moderne is run by myself and my managing partner, Constance Friedman. We've been working together for over 7+ years, but we've known each other for well over a decade. And Constance started the fund in the mid about in 2015-16. I joined a little bit later, and the fundamental premise of the fund has always been how can we be impactful to our companies, and that's where the Moderne Passport comes in. Today, we are a firm with almost 600 million under management. We have 3 core funds as well as the beginnings of a growth fund.
That is. So is every company that you invest into, do they have to go through the Passport program, or do you have investments that are not Passport specific?
We definitely get asked that question a lot. And the answer is 99% of the time, the companies go through the Passport program. Fundamentally, if a company doesn't want our help and doesn't want us to be impactful, it's probably not the right investment for us. Right. There are certainly companies that are outside of our sphere and don't make sense. And that just, kind of is what it is. But we're very focused on the companies that are focused on expanding in our industries. And we're very much focused on helping them.
Yeah. So it's, I have so many questions about Passport and the sort of unique advantage that gives you. But I found something on your site, which I don't think I had read before on any other VC funds, like public materials, which is you describe yourself as generalist investors, but vertical specialists. Wondered if you can give me a flavor of like, what does that actually mean?
Well, right. So, often because we invest around the real estate space, we'll get lumped into the prop tech
Yep.
bucket. But
Yep.
if you really look at our website and you look at the types of companies that we invest in, it's much, much broader than simply prop tech. And there's a fundamental reason for this. It's a fundamental thesis behind the fund. This strategy that we're embarking on now was actually started in 2008 in the middle of the GFC. And fundamentally, real estate obviously suffered, a great downturn at that point. And the way that we believe that the companies that are going to be strongest to serve the real estate, insurance, and fintech industries have multi-vertical applications, so that they're not, subject to the cycles of any one particular, industry. So if you had a company as an example that was just focused over the last couple of years on commercial real estate, they would have had a really hard time because commercial real estate's been in a massive downturn. But if you have a company that's focused on real estate, automotive, and finance, obviously there's all, cycles to the economy, but they're much more protected than you would be if you're very narrowly focused on real estate.
Definitely.
So when we look at companies, we really take a generalist view, like what's the total TAM here? What are all the different industries that this company can serve? And then we have actually a true expertise around the real estate industry. So because of our corporate LPs, which include large multifamily owners, which include private equity investors in real estate, which include mortgage insurance, single family rental, kind of all across the asset classes. So we definitely have a particular vertical expertise, but we take a general view to companies in terms of our valuation.
And what does, you've all of these sectors that are real estate or real estate adjacent, and then obviously a whole host of corporate partners beyond that. What do the corporate partners get out of interacting with these passport companies that is different or unique to the modern sort of style and approach?
Right. I mean, we heavily screen, obviously, both the passport companies and the investment companies that come through. And, really fundamentally, we will only look at companies that can improve net operating income or NOI, right? So, it's very much innovation, but innovation with results to the bottom line, which is, obviously it may sound simplistic, but, there's lots of nice to have companies, and particularly in real estate, which is a cash flow industry, that doesn't really resonate. What really resonates is companies that can in some way improve the net operating income of these larger corporates. So we're really focused on companies that can be impactful to our end partners.
So this is, feel free to push back on this characterization, but I believe that if you had spoken to a bunch of people across certainly Silicon Valley, they would maybe say that real estate is a more conservative industry, not as tech forward, like lacking in sort of this forward thinking approach. Do you find that how would you feel about that characterization? Do you think that there's true elements to it, or is that
I believe it's very accurate. I believe it's very accurate. Real estate's fundamentally an anachronistic industry. They are a cash flow industry, obviously. So, less apt to adopt technology. I often compare where real estate tech is to sort of, cable before Netflix. We're sort of like kind of in that area. There's a piece of it that's, kind of behind, the Fortune 5,000 in terms of adoption of technology. We at Modern fundamentally see that as an opportunity because the US, the spaces that we look at represent over 25% of the US GDP. Okay. So you have 25% of the US GDP that really hasn't adopted a technology at the same pace as the larger, Fortune 5,000, Fortune 500 that you're seeing out there. We think there can be just as much impact in the real estate industry as in some other industries that have adopted, like the finance industry have adopted technology quicker. See that as a huge opportunity.
And do you think that there's always this question when we talk to even larger startups, or certainly enterprise focuses on innovation, there's this build versus buy dilemma that they often go through. In the real estate industry, I would assume that the likelihood to build is just much lower on the tech side for many of these corporates. So the buy aspect and or buyer partner becomes a much bigger share of how they're allocating innovation capital.
Yeah, absolutely. I think, the firms that we work with are increasingly getting, more sophisticated, adopting AI, have data
Mhm.
scientists, often. But, to have, full development teams that are going to build competing products is not necessarily where these firms focus. They're in the business of square feet, I often say, not in the business of software development. So from that perspective, the build versus buy, I would say, comes in less in the real estate industry.
Yeah, the business of square feet is not something that I hear often in Silicon Valley. So that's I love the different aspects there. So wait, I want to focus back on Passport for a second. Everyone in startups is pretty familiar with Y Combinator,
Sure.
Techstars, these like early stage accelerators that are basically crash courses effectively in going 0 to 1 on a company. Talk to me about why Passport, like how Passport is more focused or different from that sort of acceleration phase.
Sure. Well, first of all, I think it's the stage of the company. So we really, at Modern, even in the Passport program, we really have to have companies with products that can be in some way nationally or regionally distributed, right? We
Mm,
can't really deal with companies that don't have a fully formed product. There's many, people that can help companies at that stage. We're not
sure.
necessarily the people for it.
Yeah.
In terms of, just kind of who's on the Passport team, we have about 7 individuals who work full time on this. This is their full-time job. They
Yep.
are industry experts in some of the real verticals in real estate. So multifamily, commercial, commercial office, right? So they have deep, deep industry contacts. What we do with the companies, because often, as you said, we have this generalist idea on how we work with companies. So often we're taking companies from outside the industry and bringing them into the real estate industry. So we need to teach them the business of square feet, right? How do you
Yeah.
sell into real estate, right? What are the things that are important to the constituents that you're talking to? So we
Are they
actually
already looking to get into real estate, or are you basically opening up their eyes that this is an opportunity that they haven't even
It's
thought of?
often both. It's often
Yeah.
both.
Yeah.
I'm going to talk about a company that we just announced today that we invested in, and you're going to say you're not going to understand initially why a firm focused on real estate would invest in it, but I'll
Hmm.
talk you through it.
Okay.
Um, so what we do with the companies is we first almost give them an education to say, these are the different asset classes in real estate. This is what's
Right.
important in different asset classes. Here are the people that you need to talk to at those, different asset classes. And then we really work with them on that NOI, ROI pitch, right? To really have impactful, how are you going to affect these businesses, right?
Yeah.
Um, and then what our team does is actually sets them up with 50 one-on-one meetings with executives in our industry. So the
Wow.
executives there are LPs, but it's also a larger group, about 1,500 execs. They've just signed up to hear about innovation. And what we do is we curate the right companies for them to meet with, and the companies get the opportunity to do a soft sales pitch. Sometimes it's on Zoom, sometimes it's here in Vegas. We're having mentor meetings here today in Vegas, right?
Love it.
And sometimes it's in person. So we have these one-on-one soft pitch meetings. We take them to events as we're here at RetCon and HumanX in Las Vegas. And then we really work with them on a pilot so that companies have a lower no-cost way of trying this new product. And then
Mm.
fundamentally at the end, we're really building pipeline, and we judge ourselves by how many pilots, partnerships, and channel opportunities we got for our companies going through the program. And we actually report back on that. That's how systematic we are with the companies on what we've accomplished for them.
I love that. What's maybe a little tangent here on pilots? It's something that is spoken about all the time in early stage venture, and I think there's still a ton of confusion about what constitutes a pilot and also what the level of signal that an investor or other people can get from a pilot, successful or unsuccessful. How do you structure these pilot programs? Or you said it was low or no cost. Like, has there been big changes in the way that companies do pilots?
Sometimes it's lower no cost. Sometimes it's based on the number of buildings, right? So
Yeah.
I'll give you an example. Like we have a really exciting company called Airwave. It does managed Wi-Fi for multifamily. You actually have to install the managed Wi-Fi. That cannot be done for free, right? So
Right.
what a
Totally.
pilot for them would be 3 buildings, right? We're going to work with you on these 3 buildings, and we're going to show you how your NOI increases, how your asset value increases by installing this owner's network, right? So that could be, in terms of a pilot. We
Yeah.
have data companies like a company called Clue, um, which helps marketers determine, tastes across different verticals. So I always give the example of they work with people like American Express, where if you like Blue Bottle coffee, you probably like Lululemon, and you probably like this actor, right? So they can actually look at the
Don't
different tastes.
don't define me that way. I'm sure my
We're
tastes are
unfortunately
far more
very
expensive.
definable. We're unfortunately very definable.
That's fair.
People like American Express and Match are using Clue to market different products, based on taste.
Mm.
And people in the real estate industry are looking at commercial and retail space and saying, what different combination of stores should we have here that have good affiliations with each other? So,
Mm.
in the case of Clue, because it's a data product, we could do we could do a very low cost pilot, right? In the case
Right.
of Airwave, where it's a managed Wi-Fi solution and there's construction involved, a pilot would mean a few buildings.
Does Passport change drastically change depending on whether or not the company in question is building a physical thing versus just software?
Well, we don't invest in just purely software. So we
Okay.
are open to different business models. So each company kind of goes through some group aspects, but really 90% sort of their own track in terms of what they're doing. So it definitely is very customized and very bespoke for each company.
Why don't you think so? This approach, when I boil it down in my head, it feels like one very specific to a set of customers who wouldn't otherwise have access to this kind of innovation place, which is an obvious benefit back to your LPs and then your corporate partners. But for the startups themselves, it also feels candidly like a much more tailored and focused approach to the thing that they want most, which is actual revenue, right?
Actual
Pathways
revenue.
to clients. Why are you the only people that I've heard about doing this?
It's really hard and it's a ton of work. That's what I always
Mm.
tell my partner Constance when we say, "Oh gosh, someone's going to do this." I said, "Oh my gosh,
Right.
we have 7 full-time people doing this. Their entire job is working through this and working through this program. We've done it 150 times. So we know what
Right.
works and we know what doesn't work. We know which companies are going to work in the program and which don't. I mean, part of like anything else, it's who you pick, right?
Yep. Yep.
Harvard's the best school in the world because they pick the best kids, right? So in many ways, it's really about the selection process. And in many ways, we go out and find the companies to come into the program. We certainly get
Right.
applications in, but not every company is going to realize the opportunity that there could be in the real estate and adjacent industries. So we're going to go out there and sell them on that. So
Yep.
I'll tell you about perhaps a deal that was announced today. I know it's a really good example of something that wouldn't be obvious that you can see from Modern. So we closed a deal called Trust and Will. Trust and Will.
Yep.
I'm sure you've heard of it. It's a
I
great
have. Yep.
name. They are providing digital wills and digital trusts for people. Very important. Most people don't have a will or a trust, which is amazing in the sense that if something happens, your estate can end up in probate. There can be siblings fighting. There can be all of these things happening. And, it's an intimidating and expensive offline process that Trust and Will has brought very, very successfully online. We led this deal through our growth fund. It was about a $25 million close that happened today. And, the obvious question is trusts and wills and real estate. Like, what
Right.
do those two have to do with each other? Well, everyone should have their house in a trust. Okay. That's the only real way to avoid probate. And in Modern's network, we actually have some of the largest residential brokerages in the country. So firm called Anywhere, which is now called Realogy, some of the other really, really large real estate brokerages. And what we're going to try to do with Trust and Will is use those real estate brokerages as a sales channel when people are buying and selling homes.
So did the founders at Trust and Will understand the potential of the real estate market as a distribution channel or as another customer segment for them, or was this an education process?
I've been talking to them for 5 years, so I guess they were probably
They probably hopefully understand it at this point.
That's how often deals happen. I kind of missed the early round, so we kind of led the growth round.
Yeah.
But they had already been thinking about probate a lot. So this was something that was very clear to them. And the people do trusts and wills at life events, right?
Yep.
You get married, you have a baby, you buy a house, right? Those are the times. Those are the key times when trusts and wills are created. So there wasn't much education needed on their side that this was an obvious sort of life point to get a trust or a will. So we're really excited. We literally announced it today, and this company is really something that we believe can be a multi-billion-dollar opportunity.
I love it. I love it. Congrats on the investment.
Thank you.
The it brings up this interesting idea though, which is you mentioned a couple times. Sometimes you have to pitch founders on the potential of dealing with an industry that, again, in most techie heads is more conservative, slower paced, et cetera. Why do you Is it just that there's this cultural disconnect that why more startups are not even trying? Like, I don't know that many startups that are even trying to sell to these sorts of industries. Is it just that they feel as though the sales cycle is going to be too long or they don't understand it? And that's why they're reticent to even give it a shot?
I think the real estate industry is a little more opaque than, other industries in some ways. There's a lot of there's REITs obviously out there. There's
Sure.
a lot of private ownership of these assets necessarily. So some of the biggest, what I always say about real estate, some of the biggest companies you've never heard of,
Yeah,
right?
right, right.
So they're enormous, massive companies with hundreds of thousands of units that the average person has never heard of, right?
Hmm.
So I mean, I think it's a bit of an opaque and difficult industry to penetrate into. And because it's a little bit more offline, it's less obvious on, how to interact with them, how to get contacts, how to do all those things. It's a relationship business in many ways as well, right? More of kind of an old-fashioned relationship business. So Passport is really pivotal for something like that because we help with something that's more difficult to break into.
Yeah, it doesn't seem as though the playbook for this sort of sale and this sort of commercial relationship is quite as easy to follow as the standard B2B SaaS, go and find some other tech companies that want to use your product and kind of grow from there.
For sometimes selling into real estate, getting a bunch of BDRs is not really going to necessarily work.
Yeah.
There are products that it does. I won't say that's not across the board in any way, shape, or form. But
Yeah.
with other things, it's really about a lot of discovery on who's actually who's doing a value add remodel, who's installing EV chargers now, who's got money to do this or that. So there's just it's a lot of information that's not publicly available.
Definitely. Well, you mentioned there about a little bit on how, maybe company structure is different in these businesses, et cetera. I'm wondering if we could pivot a little bit towards the way that you've seen these businesses be built over the last 5 or 10 years. Obviously, I am required by law here in Silicon Valley to mention AI during all of these conversations. So I'm wondering if you have ideas about how AI is changing the level of capital needed in these businesses. Has it come to the real estate industry yet? Like, what's your view on that part of the market?
Yeah, I mean, we actually recently made an AI investment called V7. And V7 is working in healthcare, insurance. And we said, we really think this is going to be working in real estate. And there's a few different ways that V7 is being used in real estate today initially. There's very simple things, which are like, kind of like lease and contract analysis, right?
Yeah.
Where we've obviously seen a lot of money going into that. And then as well in terms of like underwriting, right? That's another piece. And then on the visual piece, you can almost think about what if you had, AI of evaluate a facade, right? To see if there's problems with the facade in terms of damage or future issues. So
Mhm.
we definitely are thinking about AI, and obviously everyone's asking about it because it's the buzzword
Sure.
of buzzwords. I think again, real estate in many ways will be adopting AI. Most likely in a slower pace than again the rest of the Fortune 5,000.
Totally. Totally. Is there something specific, or maybe a better way to phrase this question? What are your corporate partners asking you the most right now about innovation today or what they should be focusing on? I'm assuming you also kind of play this quasi advisor role to many of them on like what is the thing that they should be thinking about a little bit ahead of time.
We kind of put those in different buckets in some ways. So here's the here and now, right? Like, how do I deal with sustainability? How do I deal with EV charging? How do I deal with managed Wi-Fi? These are like real and present sort of things. But we also
Right.
try to kind of expand kind of their horizons in terms of thinking about not just, their near-term problems but think about problems that they could have in the future and kind of really kind of expand the horizon on that. So that would
Yeah.
kind of go into sort of the bucket about AI and things of that nature. And people are asking the questions, they're interested. I really think for AI and for other things, it's about developing very clear use cases,
Mm.
within the real estate industry, and not just, handing someone something and say, go figure it out, right? You're going to have to do
Right.
something very, very specific that's saying you can do underwriting for your, purchase of this building, using it, right? Like you have to have
Yep.
a very, very specific use case. So it differs across asset classes. So we have brokerages, right? They're dealing with, lots of obviously changes in the laws in terms of commissions that have come down. So there's a lot
Right.
of things there. We're dealing with multifamily operators where cost of capital is much higher than it had been in the previous years. We're dealing with commercial office that's thinking about how do you get people, still this return to office, although it's sort of here, it's sort of not here in many
Mhm.
ways in terms of the amount of people that go to work every day. So there, for each asset class that we talk to, there's really, different immediate things they're thinking about in terms of innovation. And then we're really trying to expand their horizons to think about, things more to future proof them.
Love it. I wonder maybe it's a good point to pivot towards the way that you built Modern, because obviously in this fundraising climate, I know you recently had a write up in the Wall Street Journal, and then there's like more capital coming into this strategy, which is fantastic. I'm sure other GPs are looking at Modern and saying they seem to have fundraised in a really difficult time quite well. What are those conversations with LPs like? How are you standing out from the crowd there? What do you think that LPs are really looking for from their venture funds these days?
Well, right. So, I mean, I think first of all, when anyone's looking for anything, they're going to be looking at your overall returns and then your
Sure,
DPI, right? So,
for sure.
we certainly have strong numbers, in that regard. I think really some of the reasons I was attracted to join my partner Constance and attracted to joining Modern are fundamentally the reasons that some of our LPs are re-upping and expanding with us, which is, there's a lot of money in venture. There's a
Mhm.
lot of green, green, green money. And, often it's hard to win a deal other than price, right? So
Yeah.
especially if you're dealing with these AI type companies or whatever is, hot at the moment, really the only way a VC in some ways can differentiate themselves is by saying, I'll give you 10% more than the next guy, right?
Right.
And, we fundamentally have always had a lot of pricing discipline, but we're able to have that because we're sort of saying our money's a little better than green, right?
Right.
We're actually going to help impact your results. We're going to be there as a partner with you, building that pipeline and
Mm.
helping you essentially the way companies are all eventually, judged, which is on their top line revenue. So, we really try to differentiate ourselves by that passport program and the principle of how do we help and how are we impactful so
Yeah.
that we can, you know, like trust and will follow a company for 5 years and figure out, convince them that we're sort of the right partner for them. And hopefully, and sometimes it does, sometimes it doesn't, we can get there before there's a bidding frenzy on a company.
Mm. And it seems like, you mentioned Trust and Will is a great example. You've been following them for 5 years. Perhaps you could have, or were thinking about doing an earlier round, and then you get in at the growth stage. But you have investments from very early seed, et cetera, all the way through Series C. So how do you divide up your time? Like, how do you actually think about, is it one partner is based around individual sectors or stages, or like how does the actual division of labor work?
Well, we're hiring.
Fantastic.
We do need some more. We
So,
do need
so
some
it's
more.
working just at the margins at the
It's just
moment.
working
Yeah.
just as good. And listen, we just raised some new funds, so that's to sort
Sure.
of be expected because the cycles of how long these companies stay in your portfolio, as I'm sure you know from your data, Peter, have been getting longer and longer and longer, right? So
Wild. Yeah.
these 4 to 5, these 3 to 5 year exits are. I would like to see more of those, right? But we really see longer. So um, right now, we have one team across sort of seed and growth today.
Mm.
I do think in the future we will probably have a team that's just, primarily focused on growth because there's just a different way of diligencing and a different way of, executing on those deals. Today, we all look at, things of all different stages. And I think because of the vertical expertise, it's easy to, have that quick ability to say yes or no because we
Hmm.
have such a vertical expertise. Like,
Right.
we always, the joke around the office is don't show me another discount brokerage, right? Like, we like we've seen a million of those. And we every time, we're not interested in that for many, many reasons. I'll put that aside. But,
Yeah.
we have the pattern recognition was the word I was looking for. The pattern recognition to essentially say, we've seen that before. And
Yeah.
whatever the stage is, we'll figure that out. But we have because we have the vertical expertise, we really have great pattern recognition.
Do you think it's useful for, or would you think it would be useful for more emerging managers and those that are focused on early stage investments to spend time in later stage diligence processes to understand what those actually look like?
I I think that's a really good point, Peter. I mean, I really do mean, when you do later stage diligence, there's a lot more consultants and accountants and things
Yep.
like that involved because you're not just buying the hope and the dream, you're buying what's there today, right?
Right. Yeah.
When
Yeah.
you're looking at early stage, you're looking at Excel spreadsheets. Maybe the company is 2, 3, 4 million of revenue. It's really about the future. But in a growth stage, you hopefully have gotten to an execution point where there really is a solid, company there with tens of millions of dollars of revenue. So,
Yeah.
in that case, I think it is important. I always am shocked sometimes with companies. I'll give you the example, like with 20 million of revenue, haven't had an audit. And you go, well, at this stage of the game, at the price you want me to pay, if those numbers aren't right, that's a really big issue. And
Right.
so, those type of things I think would be helpful for early stage investors to see. I always say too, like a CFO, get it earlier rather than later because,
Mm.
when we've actually gone in and done diligence, when companies get above 8 or 10 million, we actually like to bring in an outside accounting firm because we've found that sometimes the revenue is just completely off.
Yeah.
They're
Yeah.
completely in complicated businesses that, may not just be, they might be transactional, they might be SaaS, they might have completion on, construction or things like that.
Yeah.
Sometimes those things can actually be off. So I would tell my earlier stage selves to make sure you're buttoned up.
Yep.
So that when someone like us comes in at the growth stage, all these checks that we're going to look at, we're going to hire lawyers to do legal diligence on every contract. We're going to hire accountants to go through and do an actual review of the last year's books and a cash reconciliation, right? We're going to be
Right.
doing, all these things. So
Yeah.
I think the earlier you start on the process, the less messy it is.
Yeah, might as well get professional early on,
Yeah.
right? So we can avoid some mistakes later down. You mentioned, the magic word there a little bit ago, which was DPI. Um, I wonder if you have any thoughts about, obviously DPI has been a struggle for many funds for obvious reasons, lack of IPOs, the exit market has been down, venture as a whole took a dive. But how do you think about DPI over the life cycle of a fund? No good, I would hope, LP is expecting DPI in year one. But when do those conversations start happening? Or like, how do you think about DPI for the fund? And then also, how that affects either secondaries or exits or things in the individual portcos that you're working with?
Yeah, I mean, I think it's interesting. Like I was looking at some of probably your data for 2020 funds, which we have one, which
Mm.
has some good DPI, for its stage already.
Yep.
And of those 2020 funds, which are you're 4 or 5 years sort of into the cycle at this point, right?
Yep.
90 something percent have none, have no DPI at this point. And I also think it has to do with stage of the company. We don't really invest in the seed and pre-seed stage in any significant way. If you're looking at firms that are doing that, I mean, you're really looking at 10 to 15 years in terms of those cycles.
Yes.
And I'm sure that that's why the conversation has come up against sort of a lot of these secondary players who are coming in and providing some liquidity to maybe some great companies that are 10 years old in some of these funds, right? So
Totally.
I think there's going to be, because of that life cycle extending and extending, that's why you're seeing these massive secondary funds raised because, eventually people, don't want to have 20-year commitments, right, to some of these funds, which they can
Yeah.
sometimes actually look like, right? If you're
Especially if they were promised 10-year commitments, those misalignments can
promised
get pretty tough. Yeah.
10-year commitments, but listen, if you really think about it, you get an investment period generally of 5 years. So you're really not finished investing that last dollar till year 5 in
Yep.
a new deal. Maybe it's people have been a little quicker lately. Obviously, maybe it's year three. I think things have been slowing down with this news cycle. So, that year five company, um, I wouldn't invest in the earliest stage company as that last one, right? You want to actually kind of think about your pacing and think about the type of company that you're investing in. If you're taking the super big swings that are going to take a really long time, probably earlier in the fund life, you might want to go a little bit later stage at year five, because that year five company might take another decade to mature.
Yeah. Well said. Have you, do you have really strong opinions on, when we talk to early stage managers about reserve ratios? I think there's basically two schools of thought, which is I'd like to keep a healthy follow-on ratio so that I can double down into my best bets. Or, and this is much more common at pre-seed and seed, I want barely any reserves, right?
Yeah.
I pick the companies that I think I'm great at picking at seed, and then hopefully they grow into what I need them to do. Do you have a strong opinion on either one of those strategies?
I mean, our view is to do the reserves. So,
Yeah.
I think it's just a difference in terms of like there's this is not meant to be derogatory, but a spray and pray kind of
Sure.
investment thesis on the seed and pre-seed, which fundamentally works for that, right? Like,
Yeah.
if you're writing $250 to $1 million checks and you're going to do in a fund, 50, or you're going to do, something of the sort. We're not going to do 50 investments.
Right.
So we have to have a lot more conviction going in, and hope. I mean, I think that will also come out on loss ratios in the pre-seed and seed. You're going to see 50-60% plus loss ratios. We certainly would hope not to have a loss ratio anywhere near that, because we are investing in companies a bit later stage and reserving, 100% for them.
Love it. Is there a metric that has come up in your recent talks with LPs that didn't used to come up? Are LPs asking for different things than they used to? Or is it really, look, the focus is the focus. Your core metrics need to be good?
In terms of, and
DPI, TVPI, you mentioned loss ratios is a great example of a fund metric.
I mean, so I would say there's less focus on IRR today at marks. I mean, that's obvious. 21 and 22. I mean, we had some companies marked up to over $1 billion very, very quickly. I think everyone did. Some of them are good, and some of them are probably, not exactly at that mark today. And I think that LPs have just completely, dismissed at this point those type of marks, right? And the other thing is that, some VCs will say, okay, we had this mark, it's a new day, we're going to go look and we're going to reevaluate that mark. Other VCs will not do anything until another financing event happens. So it's very hard for the LPs to get any surety on what the underlying value is, because every VC has sort of a different way of doing it. So that's why I kind of went back to the DPI conversation, because you can't lie about that, right? Like,
right.
You can't obfuscate the truth or have a rosy view on DPI. It is what it is. So I think LPs will continue that. Not to say that, listen, if you have a really exciting company, what they would ask us is, well, let us see the underlying metrics for that company, right? So, like, I'm glad it was marked at $1 billion, Liza, but can you show me the revenue that below that, right? And, I think that's the way that you can get LPs excited about underlying investments that have, great prospects, a good mark. How are you justifying that? I think they're going to the level of saying, let's actually see the metrics on that company.
Yeah, that's so well said, because there's two main points there for me, which is one, building trust with LPs through sort of passing through these underlying metrics and explaining what's really going on in the nuts and bolts of the business is just a beautiful way to engender more confidence in you moving forward. And then to your other point, which is different funds holding the same company at different marks. When we have spoken to LPs about this, two things always come up, which is one, they're annoyed for sure that is happening. And two, they almost always trust the most conservative investor.
Sure.
So like in that space, especially if you're going out and fundraising as a new VC, that's the mindset into which you are pitching your fund. Just to be aware, like PSA for all the new emerging managers out there.
Yeah, no, I think that's the case. And the underlying companies have obviously become a bit more focused on, profitable growth or more restrained, whatever you want to call it, sort of the burn at any level to kind of keep that 100% top line is definitely out the window, I would say, almost entirely, except for a few exceptions in the AI
Yeah.
space, right? So
Are you seeing that your companies are growing more leanly than they did before, just like fewer teammates, smaller headcounts over time?
they are. I mean, I think,
Yeah.
I don't think that there's any company that was alive in 2021 that didn't have cuts at some point.
Yeah. Yeah.
Because I mean, I almost think that listen, they can blame it on us as as on the boards, acting like lemmings and saying grow, 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 grow. So
Mm,
they got whipsawed I often by their boards as well when
yeah.
22 came around, interest rates rise, and we say, okay, there's no more free money anymore. You guys
Right.
have to make do with what you have. So even the companies that had extremely healthy growth metrics and weren't necessarily, had a crazy burn. Everyone, I think fundamentally everyone is trimmed back.
Yeah. 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 If you have an example of an interesting or cool way that you have seen a GP help a portfolio company, can be modern portfolio companies, can be a friendly VC fund, just any interesting way that you've seen a VC be helpful.
Any interesting way that you've seen a VC be helpful? So, beyond the normal things that we're supposed to do as GPs and board members, which is introduce investors and help on the budget and the board,
Yeah.
I think what we do at Modern is fundamentally very interesting, which is this systematic way of helping our companies grow their revenue base. And if you really want to do it in a way that's not one-off,
Mm,
it's very difficult, right? So,
yeah.
an email intro to one of the real estate companies that I perhaps don't follow up with, but or whatever it might be. But when we have a team that's metrics driven in terms of the pilots and deals and channels that they get for our companies, I think it has a different impact.
Yeah, systematically building commercial relationships sounds to me like the best thing that you can do for portfolio companies. So I absolutely love it. Liza, thanks so much for jumping on the podcast. This has been an amazing conversation.
All right, thank you.
All right, cheers. Talk soon.